Hi everyone, my name's Nick Wood, Head of Investment Fund Research at Quilter Cheviot. Welcome to the latest edition of The Fund Buyer, the podcast for all things related to the world of fund research. Before we start, my usual reminder that you can sign up to be notified about future podcasts on the Quilter Cheviot website, or simply follow #QCFundBuyer on LinkedIn. You can also now find us on Spotify and Google Podcasts for those of you that pick up your podcasts that way. As we pass the halfway point in the year, in today's Fund Buyer, we're looking back at the leaders and laggards so far and expressing some thoughts as we head into the second half. The past 6 months have been tumultuous from a market perspective, as rising interest rates, banking crises and geopolitical volatility have taken centre stage. So far this year has seen a fairly dramatic sea change in the winners and losers from an investment fund perspective too, as asset managers have attempted to navigate a fairly tricky environment. Nowhere have we seen such a reversal of fortunes as in the tech world, which came back with a bang following a difficult 2022. Ultimately, it has one thing to thank for this U-turn in performance: generative artificial intelligence, or AI. Roll back to the end of last year, and it's likely very few had heard of ChatGPT, but has rarely left the headlines since January. This has fueled some extreme positive share price movements in a subset of technology stocks, not least Nvidia and Microsoft. More broadly, this has resulted in growth indices and funds generally outperforming their value peers, something that seemed unlikely at the start of the year, with both interest rates and inflation still rising. This trend has consequently resulted in some of 2022's weakest funds becoming some of the strongest so far this year. Funds such as T. Rowe Price Global Technology, Baillie Gifford American, and Morgan Stanley Global Insight have featured in the bottom 10 performing funds for 2022, but all make the top 10 best performers this year, perhaps underlining the need to invest for the long term. Another area that surprised this year is China. At the beginning of the year, the Bank of America Fund Manager survey showed a huge amount of bullishness on China due to the reopening from COVID-19 restrictions. But this has very much not materialised in terms of equity returns, with dedicated China funds propping up the bottom of the list of poor performers. We're also increasingly seeing new launches of emerging market funds excluding China, as many struggle to get to grips with an increasing state regulatory presence in business and potential violations of human rights, let alone mentioning Taiwan. That said, China is definitely a country to keep an eye on for the second half of the year, as it currently stands out as one of the cheaper markets. It's not out of the realms of possibility that it has a resurgence, just like the tech sector this year. One area that has gained a lot of headlines of late, but doesn't feature at all among the leading funds, is Japan. The headlines at half year tell you that the market's up over 25%, depending on which index you look at, but that's in yen terms. For UK investors, MSCI Japan is up just 7%, reflecting an increasingly weak yen due to the ongoing policy of holding the 10-year government bond yield down at 0.5%. Given the moves up in other bond yields, that significantly weakened the currency. Plenty of commentators expect the Bank of Japan to relax their policy, not least because inflation has taken hold in Japan, albeit still only around the 3 to 4% level. In that instance, one would expect some currency appreciation, so again it may feature on this list come the end of the year. The investment trust space has similarly seen a return to form for technology-focused investments, with Polar Capital Technology and Allianz Technology Trust both hitting the top 10. Interestingly, however, fellow tech titan Scottish Mortgage has still not achieved the feats of 2020-2021, despite its heavy weighting to the sector, as it looks to battle back. One trend that's been noticeable in the investment trust space, though, is the meaningful improvement in discounts of some trusts, particularly those investing in some parts of private equity. This was a sector that came under huge pressure as interest rates rose and growth investing faced somewhat of a headwind. However, with underlying asset values holding up and quoted growth equities performing very well, some of those wide discounts have naturally reduced. Looking at the laggards, we can see more illiquid assets such as infrastructure and renewables struggling, as these are also often more sensitive to rising interest rates. One of the key benefits of investment trusts is their ability to invest in illiquid assets, but this clearly comes with its own set of consequences, and again helps to make the case for investing for the long term. As these interest rates begin to come down again, assets such as those should once again come good, particularly given the long-term tailwinds in place for those sectors. Some areas of private equity also weren't immune from the difficult environment at the beginning of the year. Ultimately, private equity is just like listed equity, spanning multiple sectors, regions and sizes, and thus investments will be hit by their own set of factors, as well as more macro-driven ones, such as interest rates and the global economy. For all the data that I've talked about today, please do check our website if you're simply listening to the podcast, and we've got various tables showing some of the numbers we've talked about today. Where the second half of 2023 leads us will be fascinating. There are certainly areas of the market that look optically cheap, at least on a relative basis, but all face their own challenges. Equally, the areas that have the momentum at present must at some point take a breather. But as ever, predicting that is always a very difficult task. Well, that's it from me today. As ever, thanks for listening and stay safe.